Short duration bonds versus long duration bonds sounds like a simple choice between lower risk and higher yield, but that description misses the real trade-off. Short duration bonds usually react less dramatically when market interest rates change. They return principal sooner, provide more frequent opportunities to reinvest, and can offer greater stability for money that may be needed in the near future. Long-duration bonds make a different promise. They allow investors to lock in yields for longer periods and may generate significant price appreciation if long-term interest rates decline. But the same sensitivity works in reverse. When long-term yields rise, long-duration bond prices can fall much more than many investors expect from an asset labeled fixed income. So this is not simply a competition between safe bonds and risky bonds. It is a decision about when and where the investor wants to accept risk. Short duration reduces interest rate sensitivity today, but creates more reinvestment risk tomorrow. Long duration reduces the need to reinvest frequently, but creates much larger price movements today. The correct choice depends on the purpose of the money, the investor's time horizon, inflation expectations, credit quality, and the amount of volatility the portfolio can tolerate. Smart investors in 2026 are not blindly choosing the highest yield. They're asking which duration actually matches the job assigned to the bonds. And before comparing the two sides, we need to clarify one term that is frequently misunderstood. Duration is related to maturity, but they are not the same thing. Maturity tells us when a bond's final principal payment is scheduled to occur. If an investor buys a 10-year Treasury, the maturity date is approximately 10 years from issuance. Duration answers a different question. It estimates how sensitive the bond's market price may be to changes in interest rates. Duration considers not only the final principal payment, but also the timing and size of the coupon payments received before maturity. This means two bonds with the same maturity can have different durations. Consider two 10-year bonds. One pays a relatively high coupon, returning more cash to the investor earlier. The other pays a very low coupon, leaving most of the value concentrated in the final principal payment. The lower coupon bond normally has the higher duration because more of its economic value is received farther into the future. That distant cash flow is more sensitive to changes in the discount rate. For a normal coupon-paying bond, duration is usually shorter than maturity. For a zero-coupon bond, where there are no intermediate payments, duration may be close to the maturity itself. This distinction matters because investors often purchase a long maturity bond, believing that the only relevant question is whether the issuer will repay the principal. But even when repayment is highly likely, the market price can move substantially before maturity. Maturity tells you when principal is due. Duration helps estimate how the price may respond along the way. And once duration is understood, one simple approximation reveals how dramatically short and long bonds can behave differently. A useful approximation connects duration with changes in bond yields. The estimated percentage change in a bond's price is approximately equal to negative duration multiplied by the change in yield. That sounds technical, but the basic idea is straightforward. Imagine a short duration bond fund with a duration of 2 years. If market yields rise by 1 percentage point, the fund's price might decline by approximately 2%. If yields fall by 1 percentage point, the price might rise by approximately 2%. Now compare that with a long-duration fund carrying a duration of 15 years. A 1 percentage point increase in yields could produce an approximate decline of 15%. A 1 percentage point decline could produce an approximate gain of 15%. These are simplified estimates, not guaranteed results. Coupon income may offset part of a decline. Convexity means the price relationship is not perfectly linear. Credit spreads and different sections of the yield curve may also move independently, but the approximation reveals the main point. Long duration amplifies interest rate movements in both directions. This is why a long-term Treasury fund can experience stock-like volatility even though the U.S. government's credit risk is considered relatively low. The investor is not necessarily taking significant default risk. The investor is taking significant duration risk. Short duration limits that sensitivity, but it also limits the potential price appreciation if yields fall. With that relationship established, we can now examine the actual Treasury yield curve investors faced in July 2026 and how much additional income the market was offering for accepting longer duration. On July 28, 2026, the U.S. Treasury yield curve was positively sloped. The one-month Treasury yield was approximately 3.76%. Three-month bills offered about 3.9%. Six-month and one-year securities were slightly above 4%. The two-year yield was approximately 4.26%. The five-year was around 4.35%. The 10-year yielded approximately 4.61%. At the long end, the 20-year yield was about 5.11%, while the 30-year offered approximately 5.09%. The federal funds target range was still between 3.5 and 3.75% following the June Federal Reserve meeting. This created a meaningful upward slope from the shortest Treasury maturity to the 30-year bond, but the additional compensation was not unlimited. The difference between the one-month yield and the 30-year yield was approximately 1.33 percentage points, so the investor had to ask whether roughly 1.3 percentage points of additional annual yield was enough compensation for decades of inflation exposure and substantially greater price volatility. The long end offered more income. It also required the investor to accept much more duration risk. Meanwhile, short-term treasuries continued to provide meaningful yields with far less price sensitivity. That explains why short duration remained attractive, but choosing short bonds only because their current yield looked competitive could create a different problem once those securities matured. First, let us examine the strongest case for remaining short. Short-duration bonds offered an appealing combination in 2026. Investors could still receive meaningful current income without accepting the extreme price sensitivity of a 20 or 30-year bond. The first advantage is lower volatility. When yields change, short-duration bond prices generally move less than long-duration bond prices. That can make short bonds useful beside a volatile stock portfolio or for investors who may need the capital relatively soon. The second advantage is faster principal return. Treasury bills and individual short-term bonds mature quickly. When they mature, investors receive the principal and can decide what to do next based on the new market environment. That creates flexibility. Short duration can also be useful for liability matching. Money needed for an upcoming home purchase, tuition payment, retirement withdrawal, or major expense should not normally depend on the market price of a long-duration bond. A short bond or a ladder matching the expected payment date may provide greater predictability. Short-duration treasuries may also serve as a defensive liquidity reserve. But the word short does not automatically mean safe. A short-term corporate bond can still default. A lower-quality short-duration fund can still lose money if credit spreads rise. Duration measures rate sensitivity, not the borrower's ability to repay. Still, when credit quality is strong, short duration can buy flexibility, stability, and time. The problem is that flexibility must eventually be used. Every maturing bond returns cash that must be reinvested. And if market rates decline, today's attractive income may disappear much faster than investors expect. The main weakness of short-duration investing is reinvestment risk. A short bond might offer an attractive yield today, but that yield is only locked in until the bond matures. After maturity, the investor must accept whatever rates are available at that time. Imagine purchasing a short bond yielding 4%. When it matures, comparable bonds might still yield 4%. They could yield more, or they might offer only 2.5%. That number is only hypothetical, but it illustrates the risk. The investor protected the portfolio from a large price decline, yet the portfolio's future income may fall because the attractive yield was never locked in for long. This becomes particularly important when investors remain short while waiting for a perfectly obvious signal that the Federal Reserve is about to reduce rates. Markets usually move before the policy decision becomes obvious. Long-term yields may decline and long-duration bond prices may rise while investors are still waiting for confirmation. By the time the rate cut story becomes comfortable, much of the price appreciation may already have occurred. This does not mean investors should automatically extend duration. Rates may remain elevated, inflation may persist, long yields may even rise while short rates fall. The point is that staying short is also an active decision with consequences. Short duration reduces current price risk, but increases future reinvestment uncertainty. The investor is repeatedly returning to the market and accepting whatever yield it offers next. Long-duration bonds solve part of that problem by locking in exposure for longer, but they do so by introducing a much larger and more visible market price risk. Long-duration bonds offer two potential sources of return. The first is income. Buying a long-term bond allows the investor to lock in a yield for a much longer period, assuming the issuer continues making the scheduled payments. The investor is not forced to reinvest the entire principal every few months or every year. The second potential source is price appreciation. If long-term market yields decline, existing bonds with higher fixed coupons become more valuable. Because long-duration bonds are highly sensitive to rate changes, that price appreciation can be meaningful. A fund with a duration of 15 years could experience an approximate 15% price gain if yields decline by 1 percentage point, before considering coupon income and convexity. Again, that is a simplified illustration, not a forecast. Long-duration treasuries can also provide diversification during certain economic slowdowns. If growth weakens and investors seek high-quality government bonds, long-term yields may fall while stock prices decline. In that environment, long treasuries may help offset part of the equity loss. Long duration can also match long-term liabilities. A pension, insurance company, or individual planning for a distant obligation may want assets whose cash flows respond similarly to that liability. But long duration is not merely an income investment, it is an interest rate position. The investor is making the portfolio highly sensitive to changes in long-term yields. That can reward investors who extend duration before yields fall. It can also punish investors who underestimate inflation, fiscal pressure, or the term premium. And those risks explain why a bond considered safe from default can still produce a very uncomfortable drawdown. Long-duration bonds can fall much harder than the word bond suggests. The first major threat is inflation. A fixed coupon becomes less valuable when the cost of living rises faster than expected. Investors may then demand higher yields to compensate for the loss of purchasing power. When new market yields rise, existing long-term bonds with lower coupons become less attractive, causing their prices to fall. The term premium creates another risk. Investors may demand additional compensation for lending money over several decades because future inflation, growth, and monetary policy are uncertain. Fiscal conditions and heavy Treasury issuance may also influence long-term yields, even when the Federal Reserve is reducing short-term rates. This is why investors should not assume that long yields must follow the federal funds rate lower. A long-duration fund with a duration of 15 years could experience an approximate 15% price decline if yields rose by 1 percentage point. Coupon income may soften the result, and convexity may change the calculation, but the drawdown can still be substantial. Behavior then becomes part of the risk. Investors often purchase long bonds expecting a quick rate cut rally. When the rally does not arrive and prices fall instead, they sell, locking in the loss before the duration thesis has time to work. Treasury credit quality does not eliminate interest rate risk. The government may remain fully capable of making payments while the bond's market value declines sharply. Long maturity is not free yield. The additional income is compensation for accepting uncertainty over a much longer period. Before taking more duration, investors should understand whether they actually need it or whether they are simply making a confident rate prediction. If you prefer bond analysis without rate cut hype, yield chasing, or claims that one duration always wins, subscribe to Boring Money Wins. The goal is not to predict every Federal Reserve meeting, it is to build a fixed income portfolio that can function across several possible outcomes. That means examining current yield, duration, maturity, credit quality, reinvestment risk, inflation exposure, liquidity, and the date when the money will actually be needed. A short bond is not automatically conservative if the investor must continually reinvest during falling rates. A long treasury is not automatically safe if the investor cannot tolerate a large market price decline. And the high-yield corporate bond is not simply a better version of a treasury because it offers more income. If this video is helping you understand what is hiding behind the yield, click the like button. That helps YouTube recommend the video to more investors who want fixed income education without turning every portfolio decision into a bet on the next policy announcement. The most useful question is not whether rates will rise or fall next month, it is what job each bond is expected to perform. That job also determines whether the investor should purchase an individual bond with a specific maturity date or use a bond ETF that continuously manages a portfolio. The two structures can own similar securities while producing a very different investment experience. An individual bond has a defined maturity date. The investor receives scheduled coupon payments, and if the issuer fulfills its obligations, the face value is due at maturity. Before that date, the bond's market price may rise or fall, but an investor who does not need to sell can continue holding the bond while the maturity date approaches. This can be useful when the bond is matched to a known future expense. A traditional bond ETF operates differently. It owns a diversified portfolio of bonds. As securities mature or no longer fit the fund's strategy, they are replaced with new holdings. The ETF itself normally has no final maturity date. Its duration is continuously maintained within a target range. This means waiting does not cause a traditional long-duration ETF to become a short-duration fund and finally repay a fixed face value. The portfolio continues. Its market price and net asset value keep changing with yields, credit spreads, and fund income. That does not make bond ETFs inferior. They can provide diversification, daily liquidity, professional portfolio management, and easy rebalancing. Individual bonds provide greater certainty around specific cash flows, but they may require more capital and research to achieve diversification. Defined maturity bond ETFs create a third structure. They hold bonds expected to mature near a target year and are designed to terminate, making them more similar to a diversified ladder segment. The appropriate structure depends on the cash flow need, but before choosing an individual bond or ETF, investors must separate two risks that are often combined incorrectly. Duration risk and credit risk are not the same thing. Duration risk measures sensitivity to changes in interest rates. Credit risk measures the possibility that the issuer may fail to make interest or principal payments as promised. A short-term Treasury generally has low credit risk and low duration risk. A long-term Treasury may still have relatively low credit risk, but its duration risk can be extremely high. A short-term high-yield corporate bond may have less interest rate sensitivity, yet carry significant default and credit spread risk. A long-term high-yield corporate bond can combine both high duration and high credit risk. This distinction becomes especially important during a recession. Treasury yields may decline as investors seek safety. That can increase the price of high-quality government bonds. At the same time, corporate credit spreads may widen because investors become more concerned about defaults. A corporate bond can therefore lose value even while Treasury yields are falling. The bond's yield can be separated conceptually into several components. There is the risk-free rate, there may be a term premium for lending over a longer period, there is a credit spread compensating for default risk, and there may be a liquidity premium for securities that are more difficult to trade. A higher yield may not be a free opportunity. It may be payment for risks the investor has not identified. This is why credit quality should often be selected before duration. First, decide who must repay the money and how reliable those payments need to be. Then, decide how much interest rate sensitivity the portfolio should accept. Once those risks are separated, investors can combine maturities rather than forcing the entire bond allocation into one forecast. Investors do not have to choose between short bonds or long bonds. A bond ladder spreads maturities across several dates. For example, portions of the portfolio may mature in 1, 2, 3, 4, and 5 years. As each segment matures, the investor can use the cash or reinvest it at the far end of the ladder. This distributes reinvestment risk over time instead of making the entire portfolio depend on rates available on one date. A barbell strategy combines short and long duration, while holding less in the middle. The short side provides liquidity, stability, and frequent reinvestment. The long side locks in yields and creates greater potential price appreciation if long-term rates decline. The investor accepts two very different risk profiles rather than one moderate profile. An intermediate duration core offers another approach. It normally provides more income and duration than short bonds, with less volatility than the long end. It may be simpler to manage and can serve as the central fixed income allocation for investors who do not want an aggressive rate position. None of these structures is automatically superior. A ladder may match planned expenses. A barbell may suit an investor who wants both liquidity and long rate exposure. An intermediate core may provide balance and simplicity. The best structure depends on the liability, not on the most confident interest rate forecast. Diversifying bonds across time can be just as important as diversifying across issuers. And the correct mix begins with a practical question. When will the investor need the money? Different financial goals require different duration decisions. An emergency fund prioritizes capital stability and quick access. Treasury bills, cash equivalents, or very short duration securities may be appropriate tools because the money could be needed without warning. A planned purchase has a known date. If the investor expects to need the money in 2 or 3 years, an individual bond or ladder maturing near that date can reduce the risk of being forced to sell during an unfavorable market. A long-term accumulator may use bonds primarily to diversify stock risk and generate income. An intermediate core may provide a balanced starting point, while a smaller long-duration position can add sensitivity to falling yields. A retiree has several jobs for fixed income. Short bonds or cash may fund near-term withdrawals. A ladder may support spending over several years. Intermediate and long-duration bonds may provide income, diversification, and exposure to longer-term liabilities. Inflation-protected securities may also help preserve purchasing power. The decision should begin with 6 questions. When will the money be needed? How much price volatility is acceptable? Is a specific amount of principal required on a specific date? Can income be reinvested? How much inflation risk can the investor accept? And is the bond allocation intended to provide income, stability, or diversification? Buying a 20-year duration fund for money needed next year creates a mismatch regardless of the yield. Duration should follow the financial horizon. Once every bond has a defined purpose, the final decision between short, long, or a combination becomes much less dependent on predicting interest rates. So what are smart bond investors doing in 2026? They are not simply going short because short-term yields remain attractive, and they are not automatically going long because they expect rate cuts. They are matching duration to purpose. Short duration may fit when the money is needed soon. Price stability is important, flexibility is valuable, and a large market drawdown would damage the financial plan. The trade-off is that principal must be reinvested frequently at unknown future yields. Long duration may fit when the horizon is long. The investor wants to lock in current yields. A distant liability must be matched, and large price movements can be tolerated. The trade-off is substantial exposure to inflation, term premiums, and rising long-term yields. A combination may fit investors who need near-term liquidity while also wanting longer-term income and diversification. The final framework contains 6 decisions. First, define the purpose: income, stability, diversification, or a future liability. Second, examine the available yield. Third, measure duration and the potential price impact of changing rates. Fourth, evaluate credit quality and identify who must repay the money. Fifth, consider inflation and purchasing power risk. Sixth, choose the correct structure: individual bonds, a bond ETF, a ladder, a barbell, or a diversified core. Short duration buys flexibility. Long duration locks in exposure. Diversification reduces the risk of one timing decision controlling the entire result. Do not build the bond portfolio around one rate prediction. Prepare for multiple outcomes and make every bond earn its job. That is how boring money wins.